discussed about in the previous session, we had discussed about the role of corporate governance. And today we will be talking about the elements of good corporate governance. When we can say that the corporate governance guidelines are correct or are good, that we are going to discuss now. So some of the elements that we will be discussing are: first is rule of law. Rule of law, as everyone is aware of, the meaning of rule of law. It is very simple. Whatever is mentioned in the law, whatever is mentioned in various acts, when that is followed as it is, we can say it is rule of law. That whatever rules and regulations are prescribed in law, if they are followed, it is rule of law. So the first element of good corporate governance is that various provisions are there in various acts. And the most important act is Companies Act 2013. So the various provisions which are included in these acts are to be followed in total. When a particular company is following all these things, we can say the company is going with rule of law. That is rule of law. Now, the second important element is transparency. Yesterday also we had discussed, when we were discussing about the the role of corporate governance. Transparency means that whatever the policy of the organization is, those policies, those principles, those rules and regulations can be called as transparent when they are shared with all the concerned people. For example, what will be the promotion policy in the organization? When a person is eligible for incentive, when a person becomes eligible for promotion. Now, every company is supposed to have a written policy for these particular points. Now, when the company is following whatever is written in the rule, for example, the rule is that a person who achieves the set target of the company, that person will be promoted in the organization. That is the written rule in the organization. When this written rule is communicated to all the concerned people in the organization, when everyone is aware that in this particular organization we need to achieve the set target, and when we achieve the set target, we become eligible for promotion in this organization. So making rule is one thing, and sharing that rule with all the concerned employees in such a manner that all the concerned employees are aware of that rule. Then we can say that yes, there is transparency in the organization. Sharing the rule doesn't suffice. What suffices is that that rule should be understood by the employees. It should not happen that only for the sake of sharing the rule with the employee, The organization makes the promotion policy in a very difficult English language, where difficult English words are used. When the organization is aware that most of the employees are not well educated, they do not understand or they cannot interpret the English language in a better manner. Now, the organization cannot escape that we are very transparent. We prepared a policy and immediately we mailed it to all the employees. So we are transparent. That is not transparency. The information, the practices, the rules, the regulations should be shared with all the employees in such a language or in such a way that each and every employee in the organization which is concerned with that rule should be able to understand that rule. Then we can say that yes, the organization is practicing transparency. That is the meaning of transparency. Now, the next one is responsiveness. Now, responsiveness is, again, it is the literal meaning of the word responsiveness. That whenever an employee approaches the organization about some wrongdoing taking place in the organization, immediately action should be taken against that particular complaint. Whether the complaint is oral, whether the complaint is written, action has to be taken. Then we can say that responsiveness is there in the organization. Organization has to respond. Respond to what? Respond to the complaints which are being filed by the organization. Respond to the views of the employees working in the organization. Respond to the suggestions given by the employees working in the organization. And that should be prompt response. It should not happen that a complaint was filed by the employee, but as the manager was on leave, the concerned manager was on leave for 1 month, no action was taken against that particular complaint. That is not responsiveness. Responsiveness means how quickly, how effectively you are responding to a particular problem, to a particular suggestion, to a particular view. That is responsiveness. If the management has received a complaint that there is manipulation taking place in preparation of financial accounts or financial statements, immediately prompt action should be taken by the management. It should set up an inquiry that whether the complaint which has come to the management is genuine or not, correct or not. And if it is correct, strict action should be taken against the person who is involved in such wrongdoing. And that is called as responsiveness. So, good corporate governance requires responding also. And when the company responds promptly to such problems, then what will happen? The other employees working in the organization, they will also have courage that yes, my company is a very good company. Whenever we raise any issue, they immediately try to settle that issue. If such information goes to the employee will see to it that no such wrongdoing is taking place in the organization. And that is the benefit of responsiveness. Now, the next one is consensus oriented. Consensus oriented means that the decisions, the important decisions which are to be taken by the management, those decisions should be based on consensus. Consensus. Now, consensus means that if a committee of, say, 5 managers or 5 senior officials of the organization is meeting to take a decision on a particular issue, company is going for expansion, or company has decided to lay off certain people, or company is going for diversification, or company wants to enter into a MOU with another company, or company is trying for merger or acquisition. Now, such important issues should be decided not by a single person, but it should be decided by majority of the person. Before taking the decision, it should be understood that how many people are with that particular decision in the committee. If only one person is there and that person is having authority, that is the chairman of the committee, only he wants to go for diversification, rest all the 4 members, they are against diversification. As he is the chairman of that particular committee, if he takes the decision and if he implements that decision, or if because of his authority, if he unduly influences the others to sign on the decision, that decision will never be called as a consensus oriented decision. So consensus oriented decision means where most of the senior officials were in favor of that particular decision. That decision will be called as consensus oriented decision. So that is the meaning of consensus. So instead of one person taking the decision, before taking the decision, consultations will be shall be made with different people who are related with that particular decision, and then the majority should decide on that decision. That is consensus oriented. Next one is equity and inclusiveness. Equal chances should be given to each and every connected person with that particular issue to raise or to have his voice, to have his views, or to have his suggestions. Everyone should be given a chance. So that is equity, equality, and inclusiveness. Next is effectiveness and efficiency. The policies which are to be prepared has to be effective policies or efficient policies. And effectiveness and efficiency will come only when the policies are implemented as it is. There is no diversion, there is no change made in the policy to favor someone higher, someone who is at the higher level in the organization. If such thing happens, we cannot expect effectiveness and efficiency in the organization. 3 employees have exceeded the target, or 3 managers have achieved their target or exceeded their target. Out of the 3, the best performer is Mr. A, second best is Mr. C, and the third best performer is Mr. B. But Mr. B is associated with the CEO of the organization. He is closely related to the CEO of the organization. Now, as he is closely related to the CEO of the organization, the HR department decides to promote him ahead of Mr. A and Mr. C, wherein the policy of the organization is that the top performer of the organization will be given a chance for promotion in the organization. Whenever the vacancy is there for promotion, immediately the top performer will be promoted. So rule is different, but the rule is being compromised. Why? Because the third performer of the organization or in the organization is a close relative of the CEO of the organization. So to please the CEO of the organization, the HR department decides to promote Mr. B. So here, whatever the rule is, that is not being implemented. But what is being done is that there have been the changes have been made in the rule to accommodate the interest of highest person in the organization, and his interest is that he want to see to it that his relative is being promoted, and to please him the promotion has taken place also of Mr. B. That is not effectiveness and efficiency. Now this particular decision will send a wrong signal in the employees of the organization, because earlier the management has circulated the rules and regulations or the criteria for promotion. So all the employees are aware of the existing criteria, but when they will come to know that this existing criteria is compromised to promote a closely relative person of the CEO, that will send a wrong signal. That next time it may happen that daughter of general manager or son of general manager, if he is there, then instead of taking account of how he or she has performed for the last 6 months or for the last 1 year, as he or she is daughter or son of the general manager, he or she will be eligible for promotion. So that is not going to uh, uh, achieve effectiveness and efficiency in the organization. Next is accountability. Very important, accountability. Now, managers have powers, authorities. We all are aware that manager is having authority. Senior manager has more authority than the manager. General manager has more authority than the manager and senior manager. So authority increases as the position increases. But authority comes with responsibility and accountability. It is not that manager can use only authority or he has all the authority. But at the same time, the manager has to keep in mind that authority always comes with certain responsibility and accountability. The manager of the financial department was supposed to verify again minutely the balance sheet prepared by the accounts department. As he is the head of the finance department, he is having authority that he is the highest person in the financial department. At the same time, his role is to check each and every figure again with the evidences that whether the financial statement is correct or not. And if he doesn't perform his role, and if he is using only authority, that is not good for the organization. That we can say that authority is there, but accountability is missing. So he should be held accountable for any mishappening due to that particular report, because he has not done his work properly. It should not happen that as he is enjoying the authority, he immediately shares the blame, or um, uh, gives the blame, or blames his uh, junior staff. Ki all the fault is of junior staff who has prepared that balance sheet or financial statement. I am nowhere involved in that particular mishappening. If such thing happens, again, accountability is missing then. Okay, the person who has prepared the financial statement has made some mistake. Of course, action will be taken against that particular person. At the same time, when it is expressly mentioned that the head of the department has to again recheck the financial statements or balance sheets prepared. Why? Because it is a very crucial document. All the documents are not to be verified, not to be checked with all the evidences. But when we are talking about a very crucial document, it is expected. And the rule is, the company has made a rule that the HOD, head of the department of that particular finance department, will go through the figures again, cross check with all the evidences, and then he will approve that report. But without rechecking, without verification, without going through the evidences, the manager has signed, and now the end he is blaming the junior staff. So junior staff is to be punished. But at the same time, strict action should be taken against the head of the department also, against the manager also. Why? Because he should be held accountable for the fault, for the mistake, for the irregularity in the financial statement. Then only we can say that yes, accountability is present. Otherwise, there will be no accountability. And one of the essential element is accountability. Take the onus. If mistake has been done by the manager, what is expected is that he should accept that I was under tremendous stress, and because of that I overlooked one or two figure which resulted in misappropriation in the financial statement. So I accept my fault. That means accountability. The person is not doing his role. He is not performing his role and responsibility, and he is taking undue advantage of his position and blaming the other person. That is not accountability. So accountability has to be there. That is good for a good corporate governance. And the last one is participation. Now here participation means that participation of all. Participation of the management, which is involved in the day-to-day functioning of the organization, as well as participation of the board of directors who are responsible for taking the important decision on behalf of the organization or for the organization. So equal participation, both the participation should be there, as well as the employee participation should also be there. So that is related to the elements of good corporate governance. Why good corporate governance is needed? So the answer is very simple. Why it is needed? To avoid the fraud. If you are reading newspaper or if you are continuously watching the news, every now and then you will hear a story about fraud. That there is a fraud in Punjab National Bank has taken place in Punjab National Bank. Fraud has taken place in a particular company. Fraud has taken place in, say, Central Bank of India or State Bank of India, or Kingfisher Airline or Satyam Computer System or various other companies. Now, to overcome this fraud, to stop this fraud, or to minimize this type of frauds, it is very essential that there has to be good corporate governance. Just now we had discussed elements of good corporate governance. If all these elements which we had just now discussed are present in the organization, automatically there will be good corporate governance in the organization. And if any of the point is missing or most of the points are missing, then there is not going to be good corporate governance in the company, and the company definitely will have certain issues, certain problems coming up in the near future. So, without efficient companies or business enterprises, no country will create wealth or employment. Without investment, companies will stagnate and collapse. If government enterprises do not prosper, there will be no economic growth, no employment, no taxes paid, and invariably the country will not develop. So, for development, business entities are essential. We all are aware of that. If the government promotes business activities in the country is going to develop. That is a fact. And when the company develops, when the company grows, automatically the shareholders gets attracted to invest in that particular company, because everyone wants to invest in a company that is growing. That the company which is stagnating or the company which is making loss, no one wants to invest in that particular company. So that is a fact, that companies have to be there. Then companies should grow, then only they will attract more wealth. When they attract or raise more capital, then only they can go for diversification, expansion, merger, acquisition, or kind of things. And when the companies are growing in the company, automatically the GDP of the country will increase and the country will become a developed country. But any particular country needs a well governed and managed business enterprises that can attract investment, create jobs, wealth, and remain viable, sustainable, and competitive in the global marketplace. Good corporate governance, therefore, becomes prerequisite for national economic development. But raising wealth and going for expansion and going for diversification is not the only thing. But how we are performing our business activities. Are we following all the rules laid down under various acts? If yes, then yes, that is good corporate governance. And if no, it is not a good corporate governance. If no guidelines of corporate governance are issued, what will happen? Every business entity, every business organization is going to prepare their own rules. They are going to implement whatever uh, um, they want to implement. So there will be no unanimity. And one day there will be total chaos in the country. To avoid that, every country comes up with certain guidelines, certain rules and regulations, and that is included under corporate governance. So the principles, the rules and regulations of corporate governance is very essential for making good corporate governance. Otherwise, there will be a total collapse for corporate governance. Now, the next one is the OECD principles of corporate governance. Now, yesterday and day before yesterday, we were discussing about when we were talking about various committees. At that particular moment, we had discussed that one very important committee of UK, that is Adrian Cadbury Committee, plays a pioneering role in framing the guidelines of corporate governance, not only in India, but in other countries also. At the same time, there is a organization at the world level which also plays a very vital role in designing the principles, practices, or guidelines of corporate governance. And that forum or that organization is OECD, Organization for Economic Cooperation and Development. That organization is at the world level. It's a world body which suggests changes in the principles or existing guidelines of corporate governance. So the contribution made by or the important contribution of OECD is what we are going to discuss now. So five very important things have been suggested that is to be implemented by the member countries. What these are that we will be discussing. First is the rights of the shareholders, then equitable treatment of the shareholder, the role of stakeholders in corporate governance, disclosure and transparency, and responsibilities of the board of directors. These five very important points which have been suggested by the OECD. That is the most important contribution of the Organization for Economic Cooperation and Development in the field of corporate governance that now we will be discussing. The rights of the shareholders. So yesterday also we had discussed that when in 1992, when the securities scam, which is popularly known as Harshad Mehta scam, when it took place, many people, many common people, many small shareholders, they committed suicide. And the reason was that they had earned their life saving, entire life saving in the stock market. And because of that fraud, because of that manipulation, they had lost the entire life saving. There were people who had taken loan from the bank and private money lenders, and they had invested in the stock market. So when these people lost the money, they were not having the rights which protected their interest, that even if they have lost their money, some part or some portion will be shared by the government or by the company, whatever. That provision was missing. And because of that, many people, mainly the small investors, they finished their life through suicide. To avoid such thing happening in future also, the government of India accepted the suggestion or the guidelines of OECD, which talked about the rights of small shareholder in particular, because big shareholders, they do have certain rights, but small shareholders were not having the rights. So the first guideline is the rights of the shareholder, basic shareholder right, that in case if they have any doubt related to the shares which they have purchased, which is the authority where they can approach for resolution of their complaint. The company has promised that, or they have announced that this much of premium will be shared. Sorry, dividend will be shared, profit will be shared with the shareholders. Small shareholders are there. If they do not receive the promised amount in their account, who is the authority where they can approach and file a complaint? That was missing, and now it is there. That is a very important contribution. So what are the basic rights of the shareholders? Then who will be the authority and how it will be communicated to the basic small shareholders, that these are your rights. If any of the right is violated, then these are the authorities where you can approach for violation of your basic rights. That is very important, which has been included, and that is the contribution of OECD guideline. Next is rights to participate in the fundamental decisions. Very important decisions. If the company is taking place, then those important decisions, now the shareholders can also be part. That is their right. Now the shareholders GMS right. GMS is General Meeting of Shareholders. Then disproportionate control disclosure and control arrangement should be allowed to function. Cost and benefit to voting. Now voting rights again were not there. Now it is there. So this is the contribution of OECD. And the most important contribution related to the shareholder is providing them rights, informing them about their rights, and in case of infringement or violation of their rights, the concerned authority that can be approached. That is very important. Next is the equitable treatment of shareholders. Again, the second guideline is also related to the shareholders. And that talks about what? That talks about equal treatment, equitable treatment. So, equitable treatment means that equal treatment should be given to both the big shareholders as well as the small shareholders. It should not happen that small shareholders, as the person is having only say 10, 20, 30 shares of the company, so company thinks he is a very small shareholder, so he is avoided and preference is given to the person who is holding the shares in thousands or more shares of the company. That is a big shareholder. So that should not happen. Both small and big shareholder should be treated equally by the company. That was suggested by the OECD guidelines, and that was also accepted by the country. So all the shareholders should be treated equally. Prohibit insider training. Trading, not training. It is trading. Most of you might be aware of insider trading, particularly the students who are from finance specialization. They will be aware of this particular concept called insider trading. So insider trading means it's a concept wherein small tips are given or are shared with particularly the large or big shareholders, that which shares are going to increase, which shares are going to decline. So what is to be purchased and what is to be sold. Certain tips are shared by the insiders who are associated with the stock market. That is called as insider trading. So OECD prohibited that it should not take place. And if any person is indulged in this type of insider trading, then a very strict action shall be taken against that particular person. And the next is board manager disclose interest. Now here it means that board of directors, say 10 board of directors are there, or maybe 20 board of directors are there. If 2 or 3 board of directors are having direct or indirect interest in the company, for example, 2 or 3 directors, they are having shares, 1% share or 2% share in the company. That means they are having interest in the company. Their personal interest is involved. Now, these people should share this information with the general shareholders, with all the shareholders, that they are associated with the company as director and they are holding shares of the company of this percentage, or they are having interest, their personal interest is invested in the company. Now, such thing has to be disclosed. If such things are disclosed, then we can say that yes, the equal treatment is given to the shareholders. Now, the next important contribution was of the is related to the role of stakeholders in the corporate governance, which talks about, now earlier 2 points talks about the shareholders. We all are aware of who are the shareholders. A person uh, who has purchased the shares of the company is known as a shareholder. Now, the term shareholder is different and the term stakeholder is different. Now, earlier 2 points are related with the shareholder. Now, we will be seeing the role of stakeholders in the corporate governance. Now, stakeholder includes the shareholders, it includes the employees working in the organization, it includes the suppliers, the vendors, or it includes all the people who are associated with the company. So everyone who is associated with the company will be called as the stakeholder. So there we had discussed in the first 2 points the rights of the shareholder. Here it is expected that stakeholder rights are respected. The rights of not only shareholders are to be protected, but the rights of, say, the vendors are to be protected. The rights of the employees are to be protected. So all the stakeholders' interest is to be protected. Then redress for violation of rights. So that also we had discussed just now, that in case there is violation of rights or infringement of right, not only of the shareholder but the other stakeholders also, that is to be redressed. Redress means solved at the earliest. So prompt solution should be there. It should not happen that complaint has been filed by an employee or by a vendor, by a supplier, and company is taking its own sweet time to decide upon that particular complaint. That is, that cannot be included in prompt redressal. So redress for violation of rights, redressal means solving, and solving means prompt solving. At the earliest, it has to be solved. Then we can say that yes, the company is going towards good corporate governance. Next is performance enhancement and access to information. So performance enhancement, various practices, various rules, various strategies are to be prepared by the company so that the performance of the company is enhanced. And access to information means all the relevant information, not all the information, but all the relevant information which is to be shared with all the stakeholders shall be shared, which is mentioned in various acts. The confidential information may not be shared, but rest the information which is expected under Companies Act 2013, that this particular information is to be shared with all the stakeholders, that is to be shared. Next is disclosure and transparency. Under that, the disclosure standards, then standards of accounting and audit, independent audit annually, fair and timely dissemination. Now, disclosure standards, then standard of accounting and audit. Disclosure means the information has to be disclosed. And standard of accounting and audit means, again, the rules are very clear that who is going to perform the audit of the company, who is going to do the internal audit, who is going to do the external audit, and who is going to approve those audits. Everything is laid down very clearly, and it is expected that it has to be performed in that manner only. If the company is, say, a large company, and the company has engaged the services of a firm, of a external audit firm, which is having only 2 employees. So it is not possible for these 2 employees to do the audit of a large company. This is also mentioned in the act that if the company is having a turnover of more than 1,000 crore, more than 10,000 crore, or more than that, for 100 crore firm, how many auditors should be there, or a audit firm is there, how many eligible employees the audit firm should appoint or should um, have for conducting audit of a firm which is having say uh, turnover of 100 crore, turnover of 500 crore or 1,000 crore. If the rule says that at least 10 employees the firm should be having, and these 10 employees should be involved in doing the audit of a firm which is having a turnover of more than 600 or 700 crore, and if the company is having only two, then we can say that the standard of accounting and audit is not properly implemented. That is known as standard of auditing. Then there are certain audit standards, that how the evidences are to be checked, vouchers are to be checked. For every entry, there has to be a voucher which supports that entry, and auditor is supposed to check that voucher also. How the voucher is to be checked, that is a fundamental principle which is which is there in the accounting, auditing, that is to be followed. Then we can then only we can say that standard of accounting and audit is followed. Then there has to be independent audit annually, that every year independent audit should be there. Independent audit means the auditor firm is not at all associated with the company. That audit firm should be engaged in carrying out the audit of this particular company. Because it is believed, when the third party, the audit firm is not at all directly, indirectly, is not associated with this particular company, there are more chances that they will give an independent report, a correct report. Then that report is to be cross-checked with the internal auditor and external auditor appointed by the company, so that if any misappropriations are there, it can be corrected or it can be avoided. Now, fair and timely dissemination. Fair means without any partiality. Timely means in time. Suppose auditor needs information. Suppose, suppose auditor needs evidences which can prove 5 or 6 entries which the auditor doubts. Information insemination means that it should be fair and timely. 5 voucher which supports that highlighted doubtful entries by the um, auditor, it should be immediately shared with the auditor to prove that, sir, madam, these are the voucher which supports these particular entry for which you are having certain doubts. It should not happen that auditor is after the company or the financial department, that please share the vouchers related to these 5, 6, 7, 8, 10 highlighted entries, doubtful entries. And the company is giving the excuse. The concerned clerk is on leave. The concerned manager has gone out of the country for 10 days. When he will come, then only we can share the documents. Then only we can share the information. Then only we can share the vouchers. That is not called as timely. Timely means immediate, at the earliest, as early as possible. That is known as fairly and timely insemination, a dissemination. Next is the responsibility of board of directors. Very simple responsibilities are there. The board should act with due diligence and care. Next is treat all the shareholders fairly, ensure compliance of law. The board should fulfill certain key position. The board should be able to exercise objective judgment and access to information. Now act with due diligence and care. Due diligence means that whenever a decision is to be taken by the board, they should apply their own brain also. It should not happen that the chairman of the board has taken a decision and everyone is blindly signing that particular decision. That is not due diligence. Due diligence means you are using your common sense, you are using your own brain to check whether the decision is correct for the company or not, whether it is profitable for the company or not. So all the directors should apply this due diligence and care in the same manner which we apply when our own company is there. Now, one of the director may have his own company. Now, for that particular company, how much care he is taking for every decision, same care he should be taking here also in the capacity of a board of director. Here it should not happen as his own money is not involved, so he is not taking care. So that is not expected from a board of directors. Next is treat all the shareholders fairly, that we have already discussed. Ensure compliance of law. That is again very simple. Ensure compliance of law means as board of director is considered as the highest authority of the company, it is expected that whatever is mentioned in the Companies Act 2013 or other acts which are related with the company, everything as per act is to be performed. That is compliance of law. So it is to be complied. No changes, no diversion should be from the compliances. Board shall fulfill certain key position. So key position in the board should not remain vacant. Now, for example, two board members have resigned and one board member has recently met with an accident and he is hospitalized, he is bedridden. So three key vacancies are there. At the earliest, these key vacancies are to be fulfilled by the board. Now, why it is essential that the key vacancies are to be filled at the earliest? And the reason is very simple, because if 20 is the strength of or 15 is the strength of board of director of a company, so it is expected that for every meeting, in every meeting, it should have its complete strength. Then only more productivity will be there. 15 is the strength, 3 have resigned, 1 met with an accident, and 2 are out of town, 1 is out of India, and other 2 are not well, so they cannot come for the meeting. So out of say 20 people, only 8 are present for the meeting. 12 are not there, or 10 are present, 10 are not there. 12 are there, 8 are not there. So we cannot expect productivity or good result from the board of directors. Why? Because many key people are not in the meeting. So it is expected that all the key positions, whenever it is vacant, immediately it has to be filled. The board should be able to exercise objective judgment. Objective judgment means we all are aware of what is objective judgment. that calculations are to be made. It should not be only on the basis of the experience of one person, the chairman of the board or the managing director of the company is very experienced, and only on the basis of his experience he has taken a particular decision. That is not done. That is not expected also. Experience, very good. It plays a very important role. But all the calculations are to be done. That what are the good effects of this decision? What are the disadvantages of this particular decision? Everything is to be assessed properly, and then the decision is to be taken. And the last one is access to information. Access to information, again, we had discussed in the role of stakeholders also, that for board of directors also, the company should provide timely information. The board is meeting on, say, 1st of January. Agenda is prepared, agenda is shared with the board of directors, it is there with the company officials also. On the basis of agenda, if the board of directors requires certain information from the company officials, it is the duty of the company officials that they should provide that information to the board of directors well before the meeting, not on the day of meeting. Why well before it should be provided? So the reason is very simple, so that the board of directors can go
Excuse me,
through the
sir.
information. Yes,
Sorry to disturb you, sir.
last minute, last minute.
Okay,
I
okay,
have
sir.
checked, I have checked. Last minute. Last point was there. So just last minute.
Okay, sir.
So the board of directors should come well prepared for the meeting. It should not happen that on the day of meeting they are receiving all the documents, then they are checking the document, and 1 day, 2 day are lost in checking the document or understanding the document. All this homework should be done before the meeting, so they can do this homework if they are if they receive all the concerned documents, concerned information, and that is called as excess of information. So we will stop here, and in tomorrow's session we will continue. Thank you.
Thank you, sir.
Thank you. Thank you.